Good morning, I'm Bill Hubbard, Chief Economist at Trade.com. Welcome to our weekly markets review on TIP TV. Now, my special guest this morning, and I'm glad you did show up, Marc, is Marc Ostwald, Chief Strategist at ADM Investment Management. Well, Marc, I guess we had a quite of an interesting day yesterday, okay? And we'll discuss that in a couple of minutes. And, where do we go from here? And thank goodness we only have one more week before the snap election is finally over and done with here in the UK.
Oh, indeed, indeed. We have a bit of a roller coaster ride, and yet the overarching theme, certainly this week, obviously holiday affected to some extent, is just how little activity there is in markets. And that, I think, should dictate people's analysis, because the important thing to understand is you can get actually quite a lot of intraday volatility and quite sharp movements, which would appear to suggest that there's a lot going on, but it actually are more a function of the lack of activity, and someone comes in and does something.
Maybe for some of our new viewers here or new traders, etc., there's always been a term, especially here in the UK, is sell in May and go away. Do you think they've gone away? But it does, even yesterday, although it closed down, we did have another record intraday high on the FTSE.
Oh, absolutely, and it's not really surprising in the sense that pretty much any asset market at the moment, and particularly on the equity sides, if you look at it relative to bonds, and bond yields have been falling, as we know, in recent weeks, as people start to believe the Fed's not going to be quite as aggressive, don't expect the ECB to do anything, certainly not believing the Bank of England's going to be making a move on interest rates anytime soon. And so suddenly you're looking at these paltry yields in bond markets, you look at over the equity market, and you basically say, well, yes, they may look expensive, but relative to bonds, particularly on a dividend yield basis, they look much, much cheaper.
Well, let's just look at the charts. The first one, again, major dates. As we all know, thank goodness, a week from today, it's finally over and done with. Also, we have the German election, and just in the last 2 months, Angela Merkel has gone from like neck and neck to, is there any opposition at all? And again, one thing that's not up here, but really maybe upset some of the, maybe the dollar buyers, was the potential for geopolitical risk in Italy in September.
Yes, there is. I think taking a cool, calm look at the Italian situation, as much as Mr. Renzi's hubris and his arrogance wants him to push for early elections in Italy, and as much as there seems to be some progress in resolving the banking sector problems, without a budget in place for 2018, it's very unlikely that President Mattarella, who is the ultimate arbiter of whether there'll be early elections, will actually allow this to happen, even if Mr. Renzi, in collusion with Mr. Berlusconi, who is basically just a chaos monger, would like them. I can't see that Mattarella would see this as a responsible course of action in his role as president, in ensuring that we're not going to potentially go into complete gridlock, which it looks like the current outcome.
Did you say gridlock or Greek lock?
Yes, there is definitely a comparison to be made there, yeah.
Now, looking at this, okay, the UK election. Now, as we saw yesterday morning, now let's look at the next chart, okay? Now, as we saw in the paper yesterday morning, the YouGov poll, okay, basically saying that it could be a situation where Theresa May's like 24-point lead back in, late March, early April, could be eroding minute by minute, and it could be even a hung parliament. As we saw, all of a sudden, overnight, the other night, we saw a 150-point drop to 27.38, when all of a sudden everybody says, YouGov, it's all over. Now, could you explain to some of our viewers why the YouGov poll initially, okay, and I guess to say this, looking at YouGov, I guess my feeling is, David Cameron remaining in number 10 Downing Street, as per the YouGov, would be welcoming President Hillary Clinton. So let's just say YouGov doesn't have the best record, but why? How do you break down how YouGov really does its homework?
Well, for a start, the problematic lies with the media here. They reported this as a poll. It's not a poll. It's a study based on an LSE, I think, originated model. And it has, as YouGov themselves said in their press release, but we obviously live in an age where everything, someone puts poll and an algorithm will react to it, particularly if it says you're going to have a hung parliament. This is actually a study. They said the margin of error on this is huge. They said actually in that estimate you can tweak some of the results very, very fractionally, and the outcome in terms of Conservative seats could be anything between 274 or 345. Now that's a 70-seat gap. One which says they're basically going to be out of power; they won't even be the strongest. And the other one says
You mean the
they have
Green
a
Party could overtake?
yeah. The other one says they have a 50-seat majority. So that's a pretty high margin of error. And I think the fact that Sterling managed to find a flaw fairly quickly, once people started looking more closely at the details of this study, then people started to realise, and of course we had a couple of other polls, one which showed with the panel-based poll which showed the Conservative 15-point lead, another one with a 10-point lead.
After we touched the 27.38, once that came into the market yesterday afternoon, we went back to 128.88. But I think, Mark, the key thing, and we were talking about this before we came on air, what we have seen here is a very strong move in cable from the 125 above the 130. Now, your thoughts on why we saw that?
Well, I think the important thing to understand is the weight of positioning here. So what we had up until about 5 or 6 weeks ago was a position on the IMM's sterling future where there was 100,000 contracts short. So that leaves you in a situation in terms of the market where people adding more shorts to their sterling position really doesn't become very viable, and the market is then liable to be squeezed. And what we've had in terms of incoming economic data and this massive lead that up until the beginning of last week was there for the Conservatives was people clearing out their sterling shorts. So we actually have gone from that 100,000 short 2 months ago to a position now where there's only 20,000 short, which is around average in the current constellation. And so we're now opening up this situation, and we're starting to see that also in the way the market reacted to that poll yesterday, where people can open up a lot of fresh short positions, and obviously with these sort of headlines and the people are also very keen on buying protection. But this is again one of those things where the price movement gets exaggerated by the fact that if everyone's just buying downside protection and no one's offsetting it by buying upside protection, then that naturally feeds straight through. Above all, because the market makers in this will not take a position naked anymore, i.e. uncovered. They hedge their positions because that's what the regulator wants them to do.
Now, looking at that, and we were talking about before, briefly to some of our newer traders here about the options market and how this has really had a dramatic effect on the recent movement in sterling.
Yeah, I mean, the more that you accumulate, so basically what a market maker would do is if he's basically writing a load of puts for people who want to buy protection for sterling downside, he will then offset that position by selling sterling in the forward market to make sure that his position is completely covered. And that in itself pushes sterling down. That's the inevitable consequence of it. It also means that as much as there may be not much activity going on in the spot foreign exchange market, there is activity going on in the forward market which necessarily feeds back into the spot market.
So let's look at just the last chart. And this is exactly what came in the paper yesterday and what caused panic feel, okay? And as you can see, like talking about the Conservative government could lose 20 seats and its majority. I mean, I think what's its majority now, like 16 or something?
Yeah, it's 15-seat majority,
Okay.
yeah.
Now, but again, as you just mentioned, I think we can probably, we can leave that up if people want to look at it. But I think the key thing here is, as you just said, we have seen, and this morning, the last I looked, I think sterling was off about 40 pips. Now, is it a situation where we're literally counting down now? A week from today, we will have, the results, okay?
Yes, it certainly is. And with the options market, the closer you get, the higher the volatility inherent in it. So you get even sharper movements because
Yes.
people are buying protection for a specific date. Once you're down to 1 week, it doesn't have much of a shelf life.
Don't you agree that basically, as you just said, forget the data, you talk about Fed speak and geopolitical risk. This is really going to be what the papers say this morning, this afternoon, tomorrow morning.
Yeah.
Labor, conservative, UKIP, et cetera,
Yeah.
et cetera. And that's what we're going to be trading on?
Oh, 100%. It's not going to be based on anything macro, so to speak. We had some very fine manufacturing PMI data here in the UK, very encouraging. Ironically, basically because the UK is benefiting from the strength of Europe. That's not going to play a part. It's not going to be anything to do with people's view on the Bank of England. It is purely going to be on this noise from polls, and it's ironic in the sense that if you look at the 2015 general election here in the UK, and you also look at the Brexit referendum last year, how badly did the opinion pollsters get it wrong?
Almost 100%. Now, very briefly, last night we had the beige book from the Federal Reserve, because we do know that the Fed's meeting in 2 weeks on the 14th of June. I think the market's still applying about a 87% probability. But your thoughts on the next move by the Fed, if there is one this year?
Well, certainly the Fed has signalled very strongly that they're going to go in June. There's nothing really going to stop them. What's interesting is there's been some divergence. Up until now, all the various Fed speakers have done a very good job of singing from the same hymn sheet. Now there's quite a number of them, from Lael Brainard through Mr. Evans, Mr. Bullard, who are saying we're not happy with the way core inflation is performing. It's not a million miles away, but they feel like, Lael Brainard was quoted as saying, we've been below the 2% level for 58 months in a row. That's not good enough, and therefore she wouldn't be very keen on doing that. What we have on the other side of the coin is they may still want to tighten policy, but it does mean in that situation, if we've got subpar in inflation over the next 3 to 6 months, and we probably won't get another rate hike, but we will get some quantitative tightening, i.e. some removal of the Fed's balance sheets. So there's some.
I guess the key thing is the Fed's preferred measure of inflation is the PCE deflator. Now, again, without getting too intellectual, that does not really have the same percentage of medical costs that go into the PPI, so and CPI number. So we're looking at two numbers which can be different. And basically, I mean, this was mentioned on CNBC last night, that most Americans last year, of course, had a massive increase in their medical care costs. Okay, hence the Obamacare. So the fact is that the Federal Reserve, looking at two different inflation numbers, not that it's a massive difference, but basically is showing, as you just mentioned, with the two governors basically saying inflation is not giving us the oomph or the mojo that we really need to have probably this next week's, and then possibly two more. Because I mean, I think we go in June, in September, and then quantitative easing is starting. The balance sheet is reduced, because I mean, I am expecting a fairly sizable, non-farm payrolls tomorrow. And I mean, does anybody care? I mean, we're not looking at 13, 14%. We wouldn't even be looking still at only 1%.
Yes.
Inflation, I mean, in the Fed funds rate.
Well, and I think you're right in highlighting the fact that actually the low level of both the core PCE deflator and indeed the headline deflator is a function of energy price base effects and healthcare cost base effects. So what we've got is big increases falling out from last year, and that's artificially pushing it down at the moment. But if you ask Americans, for instance, in the consumer confidence survey that we saw on Tuesday, the consumer confidence said the 1 year inflation expectations of consumers is 4.7%. And I would imagine that's probably a lot closer to the lived reality.
I think you're absolutely right. On those really depressing notes, Mark, thank you very much, and we will see you very soon. Thank you.